Today, we will talk about Fisher transform indicator, definition and how to use it in trade. The Fisher transform is a technical indicator that converts prices into a Gaussian normal distribution. This helps in spotting turning points in the price of an asset and isolating the price waves within a trend. The Fisher transform creates a Gaussian normal distribution from data that isn't typically normal distributed, such as market prices. This makes peak swings relatively rare events and helps in identifying price reversals on a chart. It's often used by traders looking for leading signals and to apply to other technical indicators like RSI and MACD. The Fisher transform formula aims to normalize asset prices and detect price reversals. It makes use of the natural logarithm and the transformation of the price to a level between -1 and 1. This formula is typically applied to price, but can be applied to other indicators as well. The Fisher transform indicator can help identify a potential price reversal area. When an extreme reading is followed by a change in the direction of the Fisher transform, it can signal a potential price drop or rise. It's also used in conjunction with trend analysis for buy and sell signals. Unlike Bollinger Bands, which use standard deviation to show when the price may be overextended, the Fisher transform uses a Gaussian normal distribution to identify potential price reversals. The Fisher transform appears as a separate indicator on a price chart, while Bollinger Bands are overlaid over the price. The Fisher transform can be noisy at times and extreme readings are not always followed by a price reversal. Additionally, asset prices are not normally distributed, so attempts to normalize prices via the Fisher transform may not always provide reliable signals. Here are 3 key takeaways. 1. The Fisher transform normalizes asset prices, making turning points in price clearer. 2. Traders can look for extreme readings or a change in the direction of the Fisher transform for potential price reversal areas. 3. The Fisher transform formula can be applied to price and other indicators, but it may not always provide reliable signals due to the distribution of asset prices. Hope this would help. Thanks for watching.